A warm welcome back to my channel again. Time to go back to discuss more building blocks towards the goal of creating right derivative strategy. Today's topic is on trading methodologies, analysis paralysis. The rise of social network sites where every piece of information is available. It's getting increasingly difficult to dissect to get the real one. Our primary goal should be to focus on basics, not to paralyze common sense being clouded by excessive analysis. Okay, let me start. When you decide to take up any work or run a business, the terms that are thrown around all the time. Strategic plan, this is the art of creating specific business strategies. Strategic initiative, this is very much action-oriented and aligned clearly with deadlines, milestones. Strategic priority, these are aligned with vision, mission, and short-term goals. Strategic project, they are like work breakdowns linked with strategic objectives. And list goes on. Analysis plays a big role to determine all of them. There is no single way to analyze any particular thing. There are always multiple methods available to analyze the same thing. You will have always the choice to find the best suited method. All depends on your goal, your style, your culture, your knowledge, your audience, your long-term vision, and many other aspects. If you wish to take up trading as business, it's no difference. Proper analysis will help you to decide what suits you best to achieve your goal. Okay, let me talk today on some of the common analysis methodologies that are adapted by investors and traders community at high level. First one is fundamental analysis. Fundamental analysis includes economic analysis, industry analysis, company analysis. In my opinion, company analysis is must-thing and critical to do. Fundamental analysis helps to discover intrinsic value of asset class or securities. Some common fundamental analysis indicators are earnings per share, EPS. This indicates the equity is in growth path or decline. Price to earnings ratio, PE. It indicates if the equity price is out of proportion or not. Free cash flow, FCF. This indicates any company operationally healthy or not. Dividend payout ratio, DPR. It indicates whether the company is making profit and distribute to the investors. Price to book ratio, PB. Return on equity, ROE. There are few more like price to sales ratio, PS. Dividend yield ratio, DYR. Debt to equity ratio, DE. I generally prioritize price to book ratio and debt situation for a stock as primary indicators to look at. However, due to present macroeconomic influences, exchange traded value may not always reflect actual value. It can be undervalued or overvalued. Based on this, one can take long-term view for a stock. Traders determine entry and exit into for the particular stock price movements in the short timeframe even it moves in opposite direction of their projection. When you follow this, probability of success on the trade goes higher. Issue is, you never know when stock price will unfold to its right valuation. It's always a wait and watch game for sure. Overvalued stock stays overvalued. Undervalued stock stays undervalued for long time. You need to apply your skills and sometimes guts to take the call to buy. You can apply lump sum or staggered investment decision on top of that to take the advantage of value averaging. Next one is technical analysis. Technical analysis is based on statistical trends of historical trading activities. This provides useful indicators to plan next trade. There are hundreds of technical indicators that signal a trader when to enter and when to exit. Let me touch upon broad-level classifications of technical indicators. Starts with moving averages. There are multiple aggregation methods with customized periods one can choose. It could be simple moving average or exponential moving averages. Some others are like price trends, chart patterns, volume and momentum indicators, oscillators, support and resistance levels. Issue is most of those are lagging indicators. Helps in creating views but not conviction. Short-term trades based on technical analysis give some probability for success. This is totally a game of probability. People do back testing on past data in order to form trading strategies. I am not in favor of it. It does not pinch you unless you have real money on the table. Success comes only after real-time failures. I always plan to take multiple small trades and experience how they work before I finalize the trading strategy. Next one I will talk about, quantitative analysis. Quant methods includes regression analysis, linear programming, data mining. Different businesses in the current age of uncertainties especially started depending more on technology and quantitative analysis. Quant analysis is based on mathematical models with current price and volume as two major inputs. Price change with high volume is reliable to predict the direction. This helps agile traders to plan for the momentum trades. Short-term trade based on quantitative analysis gives higher probability for success. Hello. What do you feel now? Yes, those are too many. There are tons of methods to do analysis. Each one has its own merits and demerits. Bigger problem is, it is always a provocation to mix multiple methods together. It actually causes paralysis to the whole effort. Try to keep things simple. I would rather go ahead and plan trades with what-if analysis. It should have more arithmetic, less statistics. Trades are taken for a purpose. Cushions are very much important, so that basic purpose is not defeated. I will calculate possible outcome based on different scenarios. Calculate outcomes with the help of any mathematical tool. For example, 1. I will analyze what is the payoff if the taken trade goes in my favor. 2. What are the drawdowns if the trade does not go in favor? 3. What are adjustments to do if the trade goes against me? 4. What is my exit plan? Hope you all get my point now. Having broader knowledge is good, but use them only where it is necessary and applicable. Knowing less is not a crime, but half-baked application can cause disasters. Try to do only that much, what you can control. That's all for today. Stay tuned for the next episode. Happy trading! Please go ahead and watch previous videos for your reference. Click on the logo to subscribe and hit bell icon for future notifications.